This podcast is brought to you by Gensler Wealth. The information discussed today is meant to be general in nature and not tailored to your specific investing circumstances. This means that you should talk to your regular Gensler Wealth advisor or your own advisor before acting on any information we discuss today. Nothing in this podcast is intended to be a solicitation, and past performance does not guarantee future returns. I must also advise you that unlike other episodes, this will be a single topic focused podcast. Bonds. Just bonds. Today on the Unlimited Podcast, a special episode, back to basics on bonds with Bonds 101. What is a bond? How do they work? How are bond coupon or interest rates determined and why do they change? Bonds versus equities, and much, much more. Let's go. Welcome, everybody, to a special episode of the Unlimited Podcast by Gensler Wealth. A few weeks ago, we had the pleasure of sitting down with Richard Usher-Jones, portfolio manager at Canso Investment Counsel, a $35 billion plus investment manager focused on fixed income, also known as bonds, also called credit in some cases. And a portion of that discussion, a large portion of that discussion was a education, or what we call Bonds 101. The financial world is not always well known to our clients and listeners. They're experts in their industries, their fields, their professions, but finance might not always be their expertise. So we like to do a lot of education with clients on different investment and financial concepts and what we're doing and how the portfolios work. And so in that spirit, we wanted to record a large portion of our discussion with Richard as a Bonds 101 primer for folks that read about, hear about, are always, seeing the media and newspapers and others talk about bonds and interest rates, but maybe don't quite have all the 101 background on it. And so I hope you enjoy this special episode. We're going to cover bonds. How do they work? Coupons, interest rates, bond ratings, the bond market versus the equity markets, what happens to bond prices when interest rates change, et cetera, et cetera. I hope you enjoy, hope you come away from this a little bit more educated on the world of, the fascinating, I should say, world of bonds. Here we go. Everyone talks about the equity markets, the papers are equity markets, the news is equity markets. What's the size of the bond market relative to the size of equity markets, just to give listeners some context, give or take?
I'd say the actively traded bond market, those that are liquid and actively traded, it's about twice the size of the equity market. But I'd say it's actually also much bigger than that, because there's a whole other category of debt that wouldn't be included in that. And that's leveraged loans, bank loans, private debt. So, safe to say, the bond market, a lot of people, it doesn't get the attention and sort of the fanfare that the equity market does, but it absolutely dwarfs the size of the stock market.
Right. And that's my understanding as well. And so I think, just to give listeners context, this is a major piece of the capital markets, and much bigger than equities would be, although equities tend to get all the glory, I guess. So, okay, so let's go all the way back to basics. So first of all, what is a bond? And just in general, how does a bond work? These are really basic, I know, but you're going to be the expert to explain this to us better than I can, I guess.
Well, it sounds like a basic question, but you kind of don't know what level they answered at. And I think
right.
When I think of a bond, it's really a contract between two parties. Let's say yourself and myself, right? If I have excess cash and you're in need of cash, well, basically we create a contract where I can lend you that money for a period of time, and I'll probably put some caveats and some protections on that. And in our world, you call those covenants. But also we're going to agree for the length of time that you're going to borrow that money from me, and also how much you're going to pay me for the use of that money for that period of time. And typical bond, say it's a 10-year contract that you and I have, I'm going to lend you, say, $10,000 for a period of 10 years, and we'd agree on a rate of interest. And let's say that rate of interest is 5%. That means you're going to pay me 5% each year for the right to use that capital of $10,000. And you typically you get paid that rate of interest twice a year. So it's a semi-annual rate of interest, or what gets called a coupon payment.
Okay. And so is this where you hear this term, clipping coupons? What does that mean?
It's funny, the term coupon is one that I've got a son. I have two sons that are doing BCom degrees, and I've tried to explain to them what a bond is and how a bond works. And one of the terms we use,
You were practicing before the podcast. It sounds like this is perfect.
well, practicing, but I hope my two sons don't hear this. I don't think I've been successful in trying to explain to them how it works. But if you, I had to imagine in learning this years ago of what a bond is. A bond was a piece of paper that was a contract, and attached to that main principle, the bond, were a whole bunch of different coupons. And if it was a 10-year bond, there were 20 coupons. Every coupon.
You're talking literally physically attached to a piece of paper that you would take off.
Literally.
Yeah.
Well, actually, you wouldn't rip it because these were pretty valuable. So you take a really sharp pair of scissors.
Yeah.
And, you call it clipping the coupons. You would cut that coupon off.
Yeah.
And you could go into a bank or a participating institution, and they would pay you the value of that coupon, and they'd take that coupon and submit that back to the issuer.
Right.
And so when you hear that term of you buy your bond and you just sit back and you clip the coupons, that's exactly what they were talking about. Years ago, you actually had bonds with the principal value, and coupons were attached to it, and that's where that term came from.
Amazing. The old school approach, and the terms continue. So you were talking about you and I entering a contract, but assuming we're not doing that, I'm not good credit. You don't want to borrow from me, that's for sure. Who issues bonds generally?
Well, I borrow from you. I just might not lend you money.
Yeah, right, exactly. Yeah, exactly. So who are the issuers of bonds that you would mostly and investors would mostly be interacting with? The issuer being the lender on the other side.
So I'd say some of the biggest issuers on the planet are countries like the government of Canada, U.S. government issuing U.S. treasuries, and all of the provinces issue debt as well. And these are federal and provincial issuers. But then one thing that we specialize in at Canso is in evaluating bonds that are issued by different businesses and corporations. So when you're buying a government of Canada bond, you're basically it's the ability of the federal government to tax us as citizens, right? And the taxes that we pay, and that's actually what services the interest payments on those bonds. And similar on the provincial side.
And that's why people say government bonds are pretty close to risk-free, because they can always just tax if they get into trouble and pay off bonds.
Pretty much. I don't outright answer saying, yeah, for sure that's guaranteed, because as you know, nothing in life is guaranteed. But
also, I'm thinking sort of Canadian government bonds or U.S. bonds, not necessarily other countries that may have some troubles.
Yeah, I'd say. I mean, if there's a default in the government, a North American government bond, we've got some pretty concerning issues.
We're in a bunker somewhere if that's happening.
Yeah.
Okay. And of course, corporations would also be doing this because they can issue equity potentially if they're public or otherwise, but bonds would be another way to finance their business or their growth, I guess.
Yeah, no, that's the difference when you're evaluating a corporate bond, you're really spending a lot of time understanding that business, that underlying business, and how it operates, how it generates cash flow, because it's that cash flow in the business that's going to be there to service the debt and to pay you your interest and allow that business to refinance when it matures.
Right. Okay, so using just following on the governments are issuing bonds and corporations are issuing bonds. As you said right at the beginning, obviously a key component of a bond is the interest rate or the coupon payment, which actually may be different things. If I'm not mistaken, you can explain. Um, why do we see why is there different interest rates or coupons for different issuers, governments, corporates, federal government versus provincial government versus BCE or Rogers or Air Canada? What determines the interest rate?
Yes, I'd say there's a couple different ways to look at it. First off, the environment. Whereas, if you look at today, interest rates are measurably higher than they were a year ago, right? So you're issuing within that particular interest rate environment, right? And then the different rates of interest on different bonds are really an indication of the health of that business, or of you can look at it on the negative side. Uh, what are the chances that they may not be able to pay you? And the more risk that exists in the ability for those interest payments to be made, typically the higher the rate of interest you need to get paid. So a more fragile business would typically have a higher coupon payment or be paying you a higher rate of interest and essentially paying you for the risk that they may not be able to continue to pay you.
Right. Okay. And so I mentioned a moment ago that actually let me ask a skill testing question first, not to you, but to the listeners, and then bring that back to this coupon and interest rate. So skill testing question for listeners. What happens to bond? And of course, I'm not actually going to be able to hear if anyone answers, but just for fun, what happens to bond prices if interest rates rise? So right now, the government is raising rates at a pretty rapid clip. What happens to existing bond prices if interest rates rise? Very, very important concept that essentially every investor who's investing in bonds, and frankly, every investor, period, should understand. And if you don't, then you should definitely call us at Genzer Wealth, by the way. But what happens to bond prices if interest rates rise? Bond prices go down, and vice versa. And maybe Richard can explain why that is, and also therefore explain, because I think I made a comment before, coupon rates and sort of the interest rate, I guess, are not necessarily the same. Maybe I'm not using the right language, but because bond prices change. So can you explain, Richard, why do bond prices fall if interest rates rise and vice versa? And then how does the coupon and whatever make up for that change?
Yeah. So, I guess the way I think about it, I've got to think about actual examples. And we've seen
Sure.
some significant moves in interest rates in the last year, as I mentioned. So let's take a simple example and say 2 years ago, you could have bought a Government of Canada bond, and it it would have been priced at say $100, the par value, and interest rates were very low.
And
So
par
say
value means, sorry, what? The face value of the bond?
correct face value and most bonds are issued at face value or of $1,000, right?
Okay.
So
Yeah.
and you talk about them in increments of $100. So you go, yeah, face value, par value, $100.
Okay.
And
That,
let's
that,
say
that's what you lend, and that's what you have to get back whenever it matures.
correct.
Okay.
And then you're paid those coupon payments or those interest payments twice a year
Right.
for the use of that money when you lend it. So let's say, and I probably should have looked to see exactly where rates were, but I know there are a number of Government of Canada bonds in circulation that only pay a rate of interest of 0.25%. So call it 25 basis points, right? So um, say you had a, a year ago, you bought a 2-year bond that was paying a rate of interest of 0.25%. So that's 1/4 of 1%.
Yeah.
Interest rates were very low a year ago. Well, you roll forward to today, that was a 2-year bond when you bought it a year ago.
Yeah.
It's got 1 year left to maturity.
Yeah.
A 1-year Government of Canada bond today is yielding about 4.3%. So no one's going to pay you $100 for that bond that's only paying 0.25.
Right.
So basically, but you know that that bond matures at $100 in a year.
Yeah.
So you basically discount that bond and the cash flows on it, that you've got two cash flows remaining, or actually three cash flows. You've got uh, two interest payments of 12.5 cents, and then you've got that principal return of $100. So, sort of simplifying this, someone would pay you basically, discounting that bond, probably $96 for that bond. And why do I say $96? Because you're going to get the two interest payments of 12.5 cents, plus that $4 discount is that rate of interest you're not going to make if you bought a Government of Canada bond today.
Right.
And, when we're evaluating a bond and say a corporate bond, all we're really doing is applying discount cash flow models, saying, what are the cash flows we're going to get paid? And we're going to attach a single price to that today. And when you talk about whether a particular company or bond is more risky, essentially what you're doing is you're evaluating the likelihood you're going to get paid. And the less likely, the more you better get paid.
Right.
Um,
And that's why I guess, I mean, maybe during, I don't want to jump ahead of ourselves here, but maybe during COVID, that those first month or so when the world looked very scary, I guess, I'm assuming bond prices for corporates or others would be coming down to reflect some increased risk. Is that what you saw then?
well, at the beginning of COVID, um, it was a significant shock to the market. And the shock with every business operator was looking around saying, how is this going to impact my business? And for some businesses, it was incredibly detrimental, like the leisure and travel business, that all travel basically stopped and ended then. And, the question was, how long is this going to last? And how much cash do we have uh, in order to keep the business alive and surviving? I have to say the shock that we saw and the business interruption for so many different industries was so significant that it caused everyone to take a real step back and try and figure out what all these new investments were worth.
Right. So we talked a little bit about interest rates and risk of different countries and companies, et cetera. You hear the terms, AAA rated or bonds or junk bonds, which doesn't sound so good, but maybe they are fine. Can you just explain sort of how somebody, and maybe you can explain also who is evaluating these sort of bonds and assigning ratings, and what does that mean for interest, for coupon rates or interest rates?
Sure. So uh, there are a number of different credit rating agencies, and some people might be familiar with the names of Standard and Poor's or DBRS, which stands for Dominion Bond Rating Services, or Fitch Rating Services. And essentially, when a company or an entity issues a bond, um, oftentimes they will pay a rating agency to rate their debt. And the higher the rated the debt, the lower the probability of default, or the higher the probability of the chances you're going to get all your money back and there's no risk to it. Um, so essentially, every entity that's issuing debt wants to have the highest rating possible, because that permits them to finance with the lowest rates of interest possible.
Right.
And the way the ratings work is the highest rating is triple A plus or triple A high, flat to triple A minus, to double A plus, to double A flat, to double A low, and then single A, and then the notch down from single A is triple B, and there's triple B high and triple B flat and triple B low. So there's lots of notches on the way down. Uh, um, and it goes all the way down to single B. And then after single B, is getting a D on your high school assignment. D is default. That means that the issuer has defaulted. They're no longer paying their interest, and it means that you're likely not getting the full value back of what you lent that entity in that business. And just gonna quickly go back to that triple B and triple B low rating, because when you go from triple B low to double B high, that's a significant differentiator, because anything rated triple B and above is considered to be investment grade.
Okay.
Everything rated double B high and below that is considered to be, actually, there's three terms they're used: junk bonds, high yield, or below investment grade.
Right.
And anything double B or below uh, is rated junk, high yield, or below investment grade. And what are those? Why do they have different names? I don't know. Actually, I think if you don't like lower rated debt, you call it junk. If you like it, you call it high yield. And if you're kind of ambivalent, you call it below investment grade. Um,
And so is there a problem investing though in junk bonds or high yield bonds? Because it seems like something lots of folks are doing. I know Canso invests in this space as well. So maybe just describe how you or how bond investors could get comfortable with bonds that some might call junk bonds.
um, sure. So uh, we have the ability to invest in high yield or junk bonds. Um, and the important thing there is you really need to make sure you're doing your work, because you're really evaluating that business and the company, their ability to service that debt. The other thing, which I alluded to in the beginning, is, let's say, go back to an example where I'm lending you $10,000. If I'm concerned that you may not be able to pay me back if you're a lower rated credit, sorry, Brian.
Yeah, I'm junk. I'm a junk bond.
Yeah, I'm maybe gonna put some caveats or some covenants in there, and I'm going to say, well, your car is probably worth $10,000 or $12,000, so um, I'm going to secure that loan of $10,000 against the value of your car. And by the way,
Right.
you're not allowed to sell your car to anybody else in the period that this loan is outstanding.
Right.
So if you cannot continue to pay the loan, well, I can take possession of your car, I can sell it, I can recover that money and that $10,000. And if I get more than 10,000, you would get the extra money back.
Right.
So it's really evaluating not just the business or the entity's ability to pay their interest and to refinance it, but also what protections that you need to have in order to get comfortable in lending that money.
And I assume as the ratings go lower and lower, which I guess is into that junk bond or worse territory, the interest rate would commensurately be going up and up and up. So if Brian Ginsler's a junk bond, I'm paying you I imagine a way higher interest rate than Justin Trudeau is paying you for a government of Canada bonds. With no comment on Justin Trudeau, just
No, that's exactly it. The higher the perceived risk of the money that you're, or the entity you're lending to, you should be paid more for that risk,
right.
and paid more in terms of that rate of interest.
So, sometimes when the market gets a little challenging or otherwise, I've seen some investors get really excited. Oh, this is amazing. Someone's issuing a bond that's paying 14%. Like, this is awesome. Let's, I think the key is they got to understand that there's a reason you're able to get 14% on a particular bond. And that reason must mean in almost all cases that there's something much more risky about it than, say other bonds that are paying far less interest.
Correct.
Okay. So I still want to talk about bonds. Sorry, go ahead.
Sorry, just to give you an example, I always, I have to think about examples. In our portfolios, we've owned bonds that have been issued by Apple, right?
Right.
So Apple, I've got, you're on my Apple iPhone, right beside my Apple iPad. They're a company that is very highly rated AA, very low probability of default, tons of cash on their balance sheet. And frankly, we would say very little risk in being a lender to Apple. So because of that, you're not actually paying that much rate of interest.
Right.
Whereas in the portfolio in the last couple of years, we've lent to a number of airlines. And while air travel is returning and Air Canada is doing quite well financially, there was a period in time where the business was under a lot of pressure. And we were comfortable at the time lending to some of the airlines, American Airlines, Air Canada, and more recently, LATAM, which is an airline based in Latin America. But because of that, we had to get proper protections with security, meaning recourse with assets behind that debt instrument, and also uh, a much more attractive rate of interest than say you would get from an Apple. Because you think, I mean, uh, maybe those are drastic extremes, but pretty good illustrating example.
Yeah. I actually want to come back to some of those airline bonds that you bought when we get into post the bonds 101 section. But let me just repeat what you said and maybe ask a question. So Apple, which is the largest company in, if not the largest, close to the largest company in the world, is described as you did, tons of cash, earning billions and billions and billions of net income each quarter. And you said their bonds would be rated double A. And double A is not the highest rating bond. Triple A would be. Is there any company whose bonds would be rated higher than Apple then? Or like what's Apple missing that its bonds couldn't be rated triple A? Or is that just reserved for really stable governments?
It's pretty much just governments. I'm thinking of instances. We've bought some bonds issued by Canadian banks where unsecured debt of the Canadian banks can be rated triple B, but there are some categories of debt rated double A, but also they've issued covered bonds that are rated triple A. And a covered bond is not only backed by the promise of the bank to pay, but also if it's covered, there's an additional pool of assets that are also backing that investment. So there can be some covered bonds that have significant coverage in backing that can be issued by corporations that are rated AAA, but it is quite rare.
Okay. So I have a few more questions about bonds in a second, but just switching back to everyone's favorite, which are equities. I say that jokingly, but you know, maybe a very simple and everyone knows the answer to this question. But as you think about stocks and bonds, which one is safer if all else being equal, and why?
But I definitely have to say bonds are certainly the safer asset. Because if you look at the capital structure of say a business, right? If uh, that business were to go into bankruptcy,
Yeah.
the bond holders need to get paid back before any money gets paid to the equity holders.
Right.
But what you forego with that is, you've got unlimited upside when you're buying the stock or the equity of a business that,
Yep.
assuming it does very well and continues to grow, you participate in that. Whereas if you buy a bond or you own a bond from a company that's paying you 5%, you're not going to do better than that 5%.
Right. Yeah, it's exactly. It's a risk reward trade off. You're getting no more than what the bond is contractually obligated to pay, but you're also first in line if something goes wrong. I think that's really the core of what I was trying to get at for people to understand. Bonds get, again, very simplistically, bonds get paid first, and then once and only once all the bondholders are paid back, then the company could start paying some of the equity holders. Okay, so I think that's a pretty good bonds 101. Only one question I'm going to ask that may be getting into the bonds 201 question, but we're starting to hear this term. Well, sorry, the term's been around for forever, but starting to hear more the yield curve. There's something called the yield curve. Can you just, and this is important for interest rates, both, current rates, future rates, etc. But can you explain to listeners what's the yield curve and what does it look like?
Sure. I mean, that's a bit of a loaded question because the look of it can change over
Yeah,
time.
well, exactly. What's it typically look like? Let's say typically as a
Okay.
start.
So if you were to build a yield curve, you typically do it with say government of Canada bonds. If you're investing in Canada. And the yield, or the rate of interest that is available and be paid on bonds of 1 year, 2 year, 5 year, 10 year, 20 year, and 30 year. And you would plot those, and you would plot, across time being on the lower axis, and you would plot those rates of interest, right?
Yes.
And what a normal yield curve looks like is you would take the longer term that you're lending money, the higher the rate of interest, right? So in a normal environment, if you're making 3% in a 1 year bond, uh, the 30-year bond might be 5%, and it's a gentle upward sloping curve. And that's where you
Right.
get the term yield curve. And so that's how you plot the yield curve.
And the concept being, why, or just for listeners, why would the interest rate traditionally or typically be higher on a 30-year bond than a 2-year bond? Like, why is the curve sloping upward? You know what I mean?
Yeah, I mean, that's debatable if it's the same credit risk like the government of Canada, but you're locking your money up for longer. So you should be paid more. And uh, there's a lot more uncertainty in that period between now and 30 years
Right.
that you're subject to. And so you're paid more for that, for
Yeah.
those assumed risks.
It's I guess the concept of time value of money along with uncertainty, et cetera. So generally, the longer you give someone your money to hold on to, the more they have to compensate you for it, relative to if you're just lending someone money for a year. There's much more knowns in the next 12 months than there are in the next 10 years, give or take. Um, okay, so if that's what a typical yield curve looks like, what does the yield curve look like today? And today being, middle of December, government has increased, both in Canada and the US and elsewhere in the world, increased interest rates dramatically over the past 10 months, or less, frankly. What does the yield curve look like today?
The yield curve does not look like the normal yield curve I described. Um, it's it's quite inverted. And so if you were to actually plot those, I would plotting that, I would start with, say, a 3-month treasury bill, which is yielding about 4.2%, and then a 1 year, which is about almost 4.4%. But then if you stretch all the way out to a 30-year government of Canada bond, it's yielding about 2.8.
Right.
So
It's almost like
there's
it's
a
upside
distinct,
down.
correct. There's a distinct inversion to it where basically the highest point is at 1 year, and it just gradually declines from there out to 30 years.
And
So
what does
it's,
that mean? Why is that?
if I knew that definitively, I'd be, yeah. Um, so one of the arguments is that an inverted yield curve is a potential sign that we have a recession around the corner.
Right.
And, I think the concern is we've seen a significant lift in interest rates, the overnight rate by the Bank of Canada and by the Fed. And that's all to address higher inflation and hopefully bring that inflation in check, and really to get in front of demand and growth in the economy. And, there is, there's a number of investors, maybe the yield curve is telling us that there could be a potential recession around the corner. And I'm being kind of cautious in my choice of words because frankly, nobody knows definitively.
Right. I had a good friend of mine and famous economist David Rosenberg on as a guest of this podcast a good number of months ago. Uh, Spoke with him recently, saw some of his presentations recently, and to your point, Richard, at least from Rosenberg's perspective, based on the stats and the charts that he's produced, generally every time, generally, and this is not a promise or a forecast by Gensler Wealth or Richard or otherwise, but generally when the yield curve inverts, there is a recession that follows for a period of time after. And I guess the yield curve's inverted because folks expect that the rates that will be the longer term rate, eventually rates are going to get lowered again to counteract the recession potentially, and maybe the yield curve returns to normal. But again, we'll see what happens in the world, but definitely want to be cautious now. So thanks again to Richard Usher-Jones, portfolio manager of Canso Investment Counsel, for helping us explain Bonds 101 in this special edition of the Unlimited podcast. Hopefully you walk away with a little bit more knowledge on bonds and how they work. And of course, at Ginsler Wealth, we are always available to answer any questions and explain financial concepts in more detail. So feel free to reach out. Thanks for listening.
This has been part of Brian's conversation with Richard Usher-Jones of Canso Investment Counsel. This podcast is not to be taken as investment advice and is not an endorsement of Canso Investment Counsel. For the full episode and more, go to ginslerwealth.com/podcast. This has been a Ginsler Wealth audio production. The Unlimited podcast is hosted and produced by Brian Ginsler and is edited and mixed by myself, David McMillan. Don't forget to rate the podcast and follow us on social media at Ginsler Wealth. Thanks for listening, and see you next time.